All right, we'll go ahead and get this started. My name is Alex Perney. I will be your presenter today. If you have any questions, please make sure you type them into the chat box. Today, we will be covering a kind of an interesting cross-section. We're going to be going into utilizing your IRA as a private lending source and also what it means to utilize other people's money with regards to IRAs and other deals and bringing that in and what that looks like. Primarily, that's going to be centered around the private lending aspect of the investing realm. So if this does seem a little bit skewed towards the private lending, that's because you can kind of apply the principle and the deal structure to either direction on when it comes to utilizing outside capital. So a few key points I want people to take away from today is that any IRA or former employer plan is going to qualify for either raising capital for your deal or lending money out for your deal. And you ultimately get to choose the investment and how you actually take on that money or you lend out that money. And the structure of the deals, and in some cases, the return on investment is going to be directly determined by you. So when it comes to the interest rate that's paid on a loan or any additional considerations, if you're bringing in capital, whether that's inclusive of profit sharing or convertible note structures where you're giving out equity of your company in exchange for some type of deal that you are putting together, that is all going to be determined by you as the investor or the person that is going to be putting this deal together. So keep in mind that there's a lot of flexibility with this stuff. It's not a one size fits all. And if you have any questions regarding this, we're always happy to help and kind of show you, the different ins and outs of the way that this works, especially when it comes to the IRA side of things. So what is a self-directed IRA? And by extension, what is a self-directed retirement account? A lot of people haven't inherently heard about this and might be a little bit new to it. So we always like to make sure we kind of cover a little bit of the basics at first. So really, in essence, an IRA in its DNA is the exact same no matter where you have it. The core structure, the IRS defined relationship of a grantor and a custodian, i.e. the client and the person you have the IRA with is the same. What differentiates companies from each other is what they actually let you invest in. We here at Advantis specialize in everything that is non-traditional, not traded on the stock market, hard to value, non-traditional. That is what we specialize in. People like Fidelity and Charles Schwab, Raymond James, they specialize in the more traditional side of things. So stocks, bonds, equities markets. And that's the primary difference between us, besides obviously size, is that there's different companies specialize in different things, but ultimately what you can and cannot invest in, with the few exceptions that we'll go into here in a minute, is going to be determined by your custodian. So we allow for all those different types of creative deals to be made in IRAs, whereas other companies just don't allow for that. And they ultimately have the ability to do that because they can choose what they will and will not hold for your particular investment. Now, when it comes to raising capital, and this goes both ways, there's a bunch of different types of ways to do it. And it really kind of is going to boil down to what makes the most sense for you and the deal that you're putting together. Not everything is going to fall into one of these categories up here, even though there are about 12 things listed up here. There's a bunch of different ways to do this. And just because you don't see something up here that really maybe lends itself well, no pun intended on the lending, lends itself well to what you are trying to put together, does not mean that there's not something out there that does work. Now, when we say notes, we're talking about promissory notes or loans. Now, this can go one of two ways. You can either be the borrower or you can be the lender. Now, with regards to this, there's a bunch of different ways that these things can be structured, well more than just four. So joint venturing, you can have a note where someone indicates that they are going to lend your entity money, or you're going to lend someone's entity money for some type of agreed upon return. Now, this might just be simple as principal and interest. This might be as complex or as in-depth as some type of profit sharing, or even some type of convertible note situation where you actually are going to be giving up equity in the company for that type of, or you're going to be receiving equity in the company for that. Now, mortgage is kind of a ubiquitous term that's used largely to refer to real estate, but a mortgage in a strictly legal definition is a lien placed on an asset. It is something that you are saying, okay, I am going to give you the secured interest in the event of non-payment that you can collect and take to satisfy the loan. It also works the other way, obviously. If you're lending someone money, you can take a mortgage or a recorded lien against anything that they have that they're willing to give up as collateral. And obviously this kind of goes into what's going to work in that deal. Now, there's a bunch of different ways that can work. I tell people, when it comes to putting liens on things, make sure that you do your research. There's different classes of assets. When it comes to actually encumbering those assets, it's not always just utilizing something like a mortgage. Real estate, and they call them different things in different states. So if you're going to be borrowing money and giving, excuse me, collateral, make sure that you understand the definitions behind that. For example, in the state of Florida, we call it a mortgage. The state of Georgia calls it a deed of secured debt. I believe the state of Texas uses deeds of trust. So, they all accomplish the same thing, but they're all called different. And if you want to put liens against things like capital equipment, especially if you're talking about raising capital for a new business, or you are trying to lend to someone through your IRA that is starting up a new business, and you're going to be taking liens maybe against pieces of capital equipment, such as forklifts, large kitchen equipment, things like that, that falls under even different purviews of things like the Uniform Commercial Code Act. So you can take liens against a bunch of different stuff depending on what side of the table you're on, and it kind of falls under the general term of mortgage, which is a secured lending platform. Now, we talked about secured, but what about unsecured? You can either take on debt or lend out debt without any security other than the proverbial goodwill of the borrower to repay it. Now, this inherently is a much more risky option for the lender, but also can be a more advantageous position because you can typically charge higher interest rates. Now, for the borrower, if you can find someone to lend you unsecured money, it's good for you because obviously there's no collateral, and maybe if you're just starting out, you don't have collateral to offer, then by all means, it's an attractive option, but you're going to pay for that lack of collateral on that. And then options contracts. An option in the most basic sense of the definition is an agreement or is a right to purchase a particular asset during a certain given period of time for a certain price. Now, this could be an interesting way to raise capital or to invest it in something from a myriad of different ways. So if someone's trying to raise capital and they have a particular deal that they've put together on that business, whether that's selling widgets or what have you, they can offer someone the ability to say, hey, I need some immediate cash right now. I'm not, I'd like to keep this, and we're going to hedge on the market. We're going to hedge on the market going one way or another. You can offer someone an option contract, and conversely, if you're trying to invest, the opposite holds true. Okay, we have a question, and again, please type in those questions. I do love this. Okay, so Sue Ellen asks, if you borrow in your self-directed IRA, does it have to be non-recourse, and doesn't borrowing trigger UBIT? Two great questions. We're going to get into those in much greater detail towards the end of the presentation, but to the effect of your first question, yes, if you do borrow money within any type of qualified plan, so that is if you have a solo 401k, if you have a self-directed SEP, simple, traditional, or Roth IRA, if you ever take on debt, it has to be what's called fully non-recourse. Now, what that means is that in the event of default, the security on that loan is the only recourse that the lender has to come after. Now, with real estate, there's some big national lenders out there that do them. If you're looking towards the more private aspect of things, it's just a topic you're going to have to broach with your with your lender on that deal. But yes, it certainly does have to be non-recourse. And there's different strategies and different ways you can make deals work. Just when you're looking at it, maybe not saying that you need to have the whole deal financed, bringing more to the table. Things that can make it a little bit more attractive for the loan to value ratios are typically the best strategies that you can use when borrowing within an IRA. And then with regard to UBIT, it's actually what's called UDFIT. They are, kind of two different names for almost the same cat in this scenario, but it's unrelated debt finance income tax instead of unrelated business income tax. But they both have very relevant standing with regards to raising capital for things, because depending on what you're doing, either of those could particularly apply. But it's not as scary of a topic with regard to that UBIT and UDFIT, and I'll kind of show you at the end of the presentation on how to calculate it and why it's not necessarily something to always stay away from if the deal is good. But thank you very much for your questions, Sue Ellen. Keep those coming in. So back to raising capital, either other people's money or using your IRA. So you have things, and if people are familiar with what a hedge fund is, it's typically, and there's a bunch of different ways, again, to kind of define these things. So they will put together large pools of money that will invest in a typical direction of a market. So they will typically focus on let's say oil and gas, commodities or something, and then they will have investors that come in, and then they will direct the investment of those funds in a particular direction towards a market goal within that particular sector, whether that is oil and gas rights in shale, or hydraulic fracturing, or let's say commodities of orange juice or futures. There's an innumerable way of these things can go. But when it comes to doing that in a much more scaled down aspect, you can put together something. And again, this kind of goes into an aspect where you, to preface any of this, please make sure that you get tax and legal advice, because this is all for informational purposes only, of putting together something where you can offer out to raise capital and things like that. And again, especially when it comes to raising capital from other people, it is money extremely well spent to go and sit down with an attorney and pay, a couple $100 for an hour or two of their time to make sure that all of this is being done on the level, because few things are going to derail your deals quicker than having an angry investor and not having solid paperwork and a solid foundation for all of this. So the legal work to make sure that you have set this thing up properly, and if you are especially taking in other people's money, making sure that you are doing it correctly and according to all state and federal regulations that have anything to do with the particular area that you're working in. So you can put together where you are going out and you can potentially raise capital from other people. And there are even situations where you could potentially even solicit that. Again, I cannot stress enough making sure that you get legal advice before you actually go out and start soliciting for investors. And those can be done in a myriad of different ways. You can have things like subscription agreements where people come in and just agree to purchase shares of a particular fund that maybe you've set up where you're looking to get invested in. Making sure that you are targeting the correct people with regards to their net worth and their liquidity according to the Jobs Act accredited investor standard. And then sometimes with those things, you will run into, on the investor side, if you are trying to buy into something like that, minimum investment requirements. But it does allow you to get your money involved with a pool of other people, or potentially, if you are trying to raise capital, allow you to pull in capital from many different sources. And then there's partnerships. You can form partnerships with many different people. I've seen it a lot with IRAs, especially if an IRA does not have enough funds in it, or any type of qualified plan for that matter, they'll bring on a partner or 2 or 3 or 10 and form a partnership to where they can get their IRA involved in a good deal while still allowing them to essentially utilize other people's money and then pay them out a return as well. Typically, this is done some form of an LLC or a trust is the most I shouldn't say effective. It's typically the most utilized method for that. Excuse me. And the reason for that is, if you're looking, especially, let's use the example of a piece of property. It is not impossible, but it is very cumbersome to put 15 people on a deed for a piece of property. It can be done. There is nothing wrong with it. It certainly is one way to do it. However, it is much simpler from a paperwork perspective if you have one entity, in most cases it'd be an LLC, on title to that property, and then everyone that is looking to invest in that has a portional membership interest in that LLC according to how much capital they contribute to the deal. Then all expenses, all income, and everything flow directly into that LLC, and then the LLC takes care of splitting all of the, particular expenses or anything else out that people might have to that the LLC is due, or the profits back to the members as well. Now, again, depending on how you're setting this up and whether or not you are going out and trying to actively find people to invest in your deal, you might need to look and see whether or not that you can only put this out there to accredited investors, or if this can be something that non-accredited investors can invest in as well. If you're interested in what an accredited investor is, I hate to kind of use the cop-out, if you will, of saying Google it, but it's very easily defined with regards to the individual's net worth, what their income standards are, whether they're married or single, if it's a trust or another type of entity, how much deposits they have to have, and things like that. So I would say you can immediately find it. It's defined under the Jobs Act, so the US JOBS Act. So if you look for it right there, it should be right there. And again, kind of the act itself is pretty explanatory with regards to how you target and do this. If you also look under Regulation D of the Jobs Act more specifically, it kind of goes into more of the formalized requirements for raising capital and things like that. And depending on how you're doing this, it can be something as formal as having full subscription documents. It can be word of mouth stuff. Again, I cannot stress enough, if you're going to be, especially if you're going to be taking on the investors, making sure that you have an attorney check it out. But if you're the one that is looking to deploy their money and get it involved with other people in particular type of investment, a lot of that threshold or that burden of making sure it's a good investment falls to you. So, you can be as risk tolerant or however you want to look at it as your heart desires when it comes to deploying your own money, but make sure that if you're taking it in, you are extremely cautious on exactly how you're taking it and how you're getting those people and the like. Now, we've covered the essentials, if you will, of what different types of partnerships look like, lending out different things. But what exactly in the context of retirement plans does this have to do with anything? Well, the cool thing is that I said the company that is offering the IRA service is ultimately the one that determines what they allow in their types of accounts, and ultimately, obviously, what types of accounts they offer as well. Here at Advanta, we try to be as flexible as possible with regards to the type of plan that you use. And for any of the context of what we're talking about today, the reason I put this slide up here is that you can understand that it's not just a Roth or traditional IRA that can be used for this. Some people, and I think it's for the amount of press that the Roth IRA gets, I like to say, oh, well, I can't do that because I don't have a Roth IRA, or it's going to, X, Y, and Z is the reason I only want to use a Roth IRA for that. A Roth IRA is fantastic. It's an extremely powerful tool. I have one. My wife has one. I love the Roth IRA, but it's not for everyone. To kind of define what these plans are in a very quick fashion, a traditional IRA is going to be the most common type of plan out there, for the sole reason that if you have an old employer's 401k, if you have a pension, if you have a thrift savings plan for service of the armed services, those are all typically going to be deductible contribution plans, meaning that you are putting in pre-tax dollars to that plan. Now, when you terminate service or employment with that employer, then you have to find somewhere to move those funds to. Now, if you don't want to pay taxes and you want to keep everything in that deferred nature, you roll it directly into a traditional IRA. It's easy, non-taxable. You put it right in there, and then it continues to grow tax deferred until you want to take some money out in retirement. Now, that can be used for anything that we cover here. Now, a Roth IRA is really cool in that you put in money after you pay taxes. And there's much fewer types of plans from an employer standpoint that allow for Roth type contributions. So most people just are either starting from scratch or have had to have much smaller amounts of rollovers from employer type plans. Now, your thrift savings plan for armed services individuals and 401ks do have Roth components, but not all employers offer a Roth component of their 401k. It's ultimately their choice. But the great thing is that since it's after-tax contributions, you pay zero tax on qualifying Roth distributions. So really cool. You get a lot of real power with that. But again, it's not going to be required for any type of investment. Now, the contributions for Roth and traditionals are relatively low compared to some of these investments that you might be interested in making, or can also be a reason that you're looking to take in capital or raise other people's money in order to finance a deal. Because a traditional and Roth IRA for the calendar year or the taxable year of 2019, individuals under the age of 50 and a half can contribute $6,000 per year, and individuals over the age of 50 and a half can contribute up to $7,000 per year. So although it is nothing to be dismissive of, it's not a amount of money that's going to get you towards a $100,000 property or a $50,000 subscription agreement very quickly if you haven't already had some monies in there or if you have something to roll over to. Now, some plans that do offer considerably higher contribution limits are things like a SEP IRA or an individual 401k. Now, the cool thing about these two types of plans, and to a lesser degree the simple IRA, although I personally can't stand the name of that plan because it is very complicated to understand, even from my professional point of view, and it is anything but simple. It's just a more antiquated plan. It has its place, but the SEP IRA largely has replaced that. With the SEP IRA, again, it's an IRA. It's a type of traditional IRA, so it's after-tax dollars you're putting in there. Now, a SEP IRA, the cool part is that you get your $6,000 or $7,000 base contribution into it for a traditional IRA, and then a SEP IRA is established for an employer. So if you're self-employed or you have a business, you can set one up, and you can contribute up to 25% of your base salary not to exceed $55,000 per year, in addition to the annual traditional IRA contribution that you're making. So you can get into the $60,000 ranges if you have qualifying income per year, deductible. It's a really cool type of plan. However, there is no Roth SEP IRA. It's always going to be deductible, and you're going to take the deduction on the business side of the contribution, because that is being made of payroll. Now, if you have a subchapter S that you've established it for, you might be able to pass that $55,000 deduction on personally. But if it's in a C corp, you can certainly use to help offset the corporate tax burden there. So there's a bunch of different tax planning strategies. You get with a professional; they can certainly help make that the best decision. The one kind of downside, though, is that you can't just say, oh, well, I paid myself $60,000. I'm going to put in that full 55. It doesn't work like that. It's always going to be a sliding scale percentage of 25% of your income with that. So you have to pay yourself a lot of money, or you have to make a lot of money in order to be able to max out that contribution, which is a blessing and a curse. You're paying higher taxes with making more money, but you can make a higher contribution. The really cool part about the reason I like the individual 401k a lot is that it has all the great rules that apply to a 401k that someone like Microsoft or IBM would have. But you get all those same contribution limits, protections for an individual owned business, for a self-employed individual. So with the individual 401k, you split up the contributions a little bit. You have $18,500 that you can take out of your own personal paycheck, plug away every year into the plan. That can be 100% compensation contribution. So if you pay yourself $18,501, you're going to have a taxable liability associated with that, so you need to make sure you pay yourself enough to cover the taxes, but you can make that whole contribution into the plan. And if you're over the age of 50 and a half, you get an additional $6,000 bump with that as well. Then the other part of this is that the corporate side of things, you can contribute up to 20% of your net operating income to that plan, not to exceed $35,000 per year per participant. So, for example, you made $100,000 of NOI one year, divide by 0.2, it's $20,000. You can put another $20,000 on top of your 18.5, or depending on your age, maybe that 6,000 as well. So that's what I like to make sure people understand, is that there's a lot of different ways to do this, and depending on your current employment situation, depending on a lot of different factors, you can use a lot of different types of plans. You can use multiple different types of plans to invest in other people's deals, or excuse me, you can partner together with your different types of plans. If you have a traditional IRA and a Roth IRA and, let's say, a health savings account, you can pull those all together into a deal and take on other people's money to help fund a deal that all of those are invested in. I mean, there is as many different ways to do this as the day is long. So I'm always happy to kind of go through this. I really enjoy it. That's one reason I've been doing this for as long as I have, is that I enjoy kind of going down those rabbit holes and figuring out the creative way to make those deals. And you can, like I said, you can be as simple as using one traditional IRA to either raise capital or to invest in someone's startup or any type of different investment, or it can get it as exotic as using every single thing you see on here to do it. So it certainly is an interesting avenue. And one thing that's not up here, just because of the low contribution limits, you can also use education savings accounts. It's not a 459 plan or a 529 plan. Those are state sponsored, but you can use an ESA for this type of investing as well. We administer ESAs as well as HSAs and everything else you see up here. All right, Steve's got a question. Do contribution to all of these plans have to be earned income? The answer is yes. So when you're talking about earned income, it's not just Schedule C. It can be Schedule E if you're taking management duties or if you're receiving payment out as a distribution for services rendered. For the most part, it does have to be earned income. The exception for that can be sometimes in the individual 401k plan, if you're participating in one that does, if you're not paying yourself out much, you can still participate in the full profit sharing portion of that, even if you're not making a ton of W-2 income from that, and you're keeping most of it as net operating income for whatever taxable reason that is. Sometimes as a if you're filing as a C corp, you want to try to flush all that out and try to keep less money in there for taxable purposes, depending if it's tax as a partnership or what, you might there's a few different reasons for that. But the 401k is going to be the one that allows you to participate in a portion of it that is not necessarily going to be the earned income. But yeah, if you're going to want to make a traditional or Roth IRA contribution, yeah, so pension and Social Security is if you're not paying, the easy way to look at it is that if it is not Social Security qualifying wages, you don't have Social Security withholding requirements for it, then you cannot use that for contributions. And also, by extension to your point about pensions, pensions are, these are types of in the same family cousins as pensions, so you can't necessarily take a distribution or income from one of these types of plans or, a pension, let's say a United Auto Workers pension, and then use that income to contribute into one of these types of plans. By extension, also Social Security is meant to be a retirement, air quotes, plan for the American public that operates in the same realm as these. So that's kind of the general thinking behind that. But unfortunately, though, yeah, it does have to be income that is derived from something that is going to have Social Security, minimum withholding requirements, FICA, FUTA, that kind of thing with it. But great question, Steve. And again, there's no comprehensive list of this kind of stuff. It's for the different types of investments are or what you're looking to raise money to invest in. There really isn't any type of guide. There is no rule and guide to this kind of stuff. You can invest in everything from farm animals and equipment, which I have seen people do, to people that put together small hedge funds to go out and to invest in a certain market specific area that they're looking for. So we just like to put this up here again. This is kind of for the people that are going back and reviewing it on YouTube, that you have that kind of list there so you can kind of take some notes on it. Now, I mentioned that, and I've continued to mention that there is no real restriction on what you're investing in. The two exceptions to that rule are here, and then there also are some people you cannot invest directly with. So an IRA or any type of retirement plan cannot directly hold the beneficial interest in a life insurance policy. Not to say that there are not insurance products that an IRA or retirement plan cannot own, but it cannot be the direct beneficial interest in a life insurance policy. The reason is that life insurance policies and insurance policies of almost any kind, if you're a named insured, are paid out tax exempt. So what's the reason that an IRA needs to do that? Well, there is none. It can create a fairly sizable tax loophole. So just keep in mind, there are certain types of insurance products that are certainly fine for IRAs to have, but life insurance is not one of them. And then anything that derives its value from collectability. Now, in the context of this presentation, that can be a little bit different. Let's say, you want to put together, someone is putting together, a fund to go out and buy, rare artwork or flip and sell watches or something. I mean, that's a big market right now. I mean, people, buy and sell things like that all the time, make a lot of money with it. The restriction on that is going to be that if your IRA is directly buying that type of thing, that it's prohibited. So your IRA cannot go out and, in the name of the IRA, buy a rare bottle of wine or a Rolex. But let's say someone has put together a LLC or a private offering to where that their business model is going to be go out, buy low, sell high, the most basic tenet of economics for sales. And that's what they're going to be doing, whether that's, again, like I said, rare bottles of wine, watches, widgets, whatever. You can certainly invest in a company that does that because your IRA owns private interest in that company, not the actual product itself. Now, where you can get into a little bit of issues, and I've seen this directly, is that let's say from the aspect of you wanting to lend money out of your IRA, and then the individual is going out to buy something that is prohibited for your IRA to own. And in this in the case of this one, the gentleman was going out and was buying artwork. Valuable. I mean, art's, obviously it is expensive, and it is very subjective as to what is considered good artwork. Some people may love Jackson Pollock's, and some people may not. Some people may think that graffiti art, such as Banksy and things like that, are works of very high art. Some people may not think that they're worth the wall that they're painted on. But that withstanding, the individual was going out and buying and selling art, and the customer that we had was lending money to that individual to go out and do this. And they had a security agreement that in the event of default, that any of the art holdings, that was the security in the loan. Well, what do you do if the individual defaults? The IRA cannot take title to that. So there was a sale clause in that note, and again, this kind of goes back to how creative you can get with this stuff, that in the event of default, the IRA would not take title, but immediately would order liquidation of all the artwork. And there was a contact for an auction house and a broker that immediately would take possession of the artwork and sell it at whatever determined fair market value was minus whatever percentage that it was. So it's kind of interesting to see that happen. And again, this goes back to creativity. You can get as creative as you want with this kind of stuff. And just because they're operating in something that may have a disqualifying investment type as a backing or involved in it does not mean you can't inherently get involved with it. So keep that in mind. Those are the big points to stay away from. Now, there are some people that you have to stay away from in this. You cannot go out and directly buy, invest with, or take on investment from any of these types of people. And this has a lot of bearing in this. So when it comes to using other people's money, you can't use these people's money, unfortunately. So the easy way to think of this in a strictly illustrative manner is direct lineal descendants and ascendants of you personally. So draw your family tree, snap a chalk line from yourself directly up and down. Those are the people you can't deal with. Pretty easy. So it's mother, father, son, daughter, spouse. You can deal with brothers and sisters, and the IRS and their wisdom, we can call it, does not have an issue with you dealing with brothers and sisters. You can do that to your heart's content. Aunts and uncles, they're okay. You just have to keep in mind that you can't, let's say, directly invest in your father's startup for the most part. And I could do a whole presentation on the rules regarding lending to disqualified individual owner businesses, but keep in mind that that's something to give us a call about. Give me a call. We can kind of go through that in much greater regard. But just in a general rule, if one of these people is putting something together, please give us a call. But for the most part, you can't directly take on capital from them, and you can't give them capital for something. All right, I got a question from Trevor. Okay, how does a person with a state or federally registered company, a 506B or a 506C, borrow money to invest in a single or multifamily from IRA holders or similar companies? Okay, so you want to essentially take on money from people with IRAs to invest in some type of multifamily investment. Typically, those are done as syndications. It can be done a bunch of different ways. So how do you do that? Well, it's kind of a bummer that we can't put people together. I'd probably be driving a lot nicer of a car if we could. The issue is that we strictly have to stay a neutral third party unless we can't endorse, promote, or put out any type of investment that someone has. With that said, we always typically try to make it a very beneficial ecosystem that we have out there. So any of the stuff that we do in office, any of the events that we go to, or the stuff that we are parts of, we try to make sure is very accessible to everyone. And by extension, the people that are interested in what we do are the people that have IRAs, and the people that are looking to raise capital can kind of come to the same places. And whether that be local or individual, I tell people to go out and also look for people that are putting on seminars to the effect of what you're looking to do, because I've met tons of good people for my company at things like that by getting out there and going and traveling and sitting through a seminar. And maybe it's not necessarily something pertinent to my investment personal strategy, but sitting through courses like especially to the multifamily aspect. Rod Cleef is a big national speaker. He's local to the Tampa Bay area. I've been to some of his stuff, and while maybe not all of the material presented there is something that is pertinent to my personal investing strategy, the networking for stuff like that is immeasurable for how valuable it is. So that's why I typically tell people a lot of this stuff is boots on the ground, word of mouth, getting out there and meeting people. And that holds true for a lot of this kind of less traditional stuff. And also, there's a lot of regulation about just kind of sending out email blasts and networking, and especially the liability. That's why we have to stay away from it of promoting or endorsing any products as well. So I tell people, get out there, boots on the ground, because a lot of our potential users of self-directed IRAs and people that have them and people that are looking to raise capital, a lot of those kind of people go to those things and get out there and like to shake hands and sit down and break bread. So that would be my recommendation to you, Trevor, is getting out there, because the networking, and I can speak from personal experience, is invaluable to that kind of stuff. Okay, so types of lending, and this can go either way. This can be you taking on debt in your IRA, or it can be you lending out money to someone. So again, there is no prescribed method for this. You're not going to go out and, you can probably read a book on every single one of these, and it can tell you why each one of these kind of things is the best way to go. But ultimately, what I would tell you is that each one of these things can be the right way to go for your particular deal. It always comes down to the deal. It comes down to the people that are involved, whether your IRA is taking on the debt, whether your IRA is lending it, what the people need, what's their ultimate goal. Ask these people that are taking on money, what is the ultimate need? Do they need short-term capital? Do they need something long-term? What kind of things do they have to offer for collateral? What type of cash flows are they going to have? It's all going to kind of determine which one of these is the best fit. And again, the nice thing is that when you're talking about investor, and this is going to kind of sound kind of funny, investor investing, when you're not dealing with someone that is going to be owner occupying the secured piece of property that you're lending on or about, the restrictions are much less. When it comes to investing, and especially when it comes to lending people money, if you're lending someone money and they are occupying the house that is the security of that loan, big time regulations on that. Things like Dodd-Frank and TRID, and it goes on and on. There's literally like thousands of pages of legislation on this stuff. Ask me how I know. A client emailed me a PDF that crashed my Outlook once that had all the stuff in it. So just keep in mind that that's the kind of stuff that this is relating to. So the kind of options you have are there. And we've seen all of this stuff, and you could put a slide that has a ton of this stuff on it. For people that aren't looking at it, you have traditional mortgage lending, which can be 5-year, 15-year terms, 30-year terms, 5-year fixed rate, or 1-year fixed rate with a 5-year adjustment on it. You can have things that have balloons on them. So you can say, hey, I'll lend you money at 30-year amortization, meaning that you make payments against the note as if it were to be paid off in 30 years. But let's say in 10 years, the note comes due. So you amortize it over 30, balloon payment at 10, so that gives someone the lower payments, but still allows you to get out of the loan in a defined parameter that's maybe under that 30-year mark. And you can get this kind of stuff really dialed in as to what's going to work best for most people. You don't have to have security. Equity participation is really kind of a cool one that I think is really interesting, and kind of an interesting indicator of the direction of especially real estate that we see a lot with clients, is that with the increasing prices of real estate, the margins are getting a little bit thinner on the front end of saying, hey, if I need to borrow money to do a rehab project, this is kind of more pertinent to the people that are lending money out for the people that need other people's money. So let's say you have someone that comes to you and says, I need money for a rehab project. Well, okay, I'm going to lend you some money. Well, I really need 180 to finish this up. I'm going to sell it for 200, but the property, I'm really going to need, about 20 grand, and it's 160 to kind of get this working. So, okay, maybe instead of you saying, okay, we'll make me monthly payments of 8% interest, say, okay, no payments until it sells, and we'll have this as a 5-year balloon note with 8% interest, with a clause in there that says I get 15% or I get 20% of the profits on the property. So let's say that there was, $50,000 of profit on the property. 20% of that comes directly back to your IRA, plus anything else that you've agreed on with the individual. And then they get the added benefit of not having to make monthly payments. So that way they get to try to utilize more of the capital they borrowed and get the property turned around quicker. You get the added benefit of having a first security position loan on a piece of real estate, and then also getting 20% of the profits on the upside of that. So you also get to participate in the value shift or the equity appreciation of the property that you typically miss out on by doing traditional mortgage lending. And again, this goes directly back the other direction. If you're trying to raise money for something you're doing in your IRA, again, it does have to be non-recourse, but you can offer any of those types of incentives to the borrower, to the lender, saying, hey, we're going to rehab this property. Maybe instead of doing this, we're going to offer you, participation in the equity or some type of profit sharing on that. There's nothing wrong with that. Absolutely, go for it. The really nice thing about lending, and again, this goes both directions, is that it's very flexible. Both parties get to really kind of look at this very objectively and say, okay, what's going to work best for most people? Obviously, the lender, this can be your IRA, this can be the other individual bringing money in. Figuring out how much money that is actually needed for this. What type of consideration is going to be given? How long is it going to take to repay this? Is it going to be amortizing? Is it going to be interest only? Are there going to be prepayment penalties? Is there going to be equity participation? And when the actual due date of that payment's due, are you going to have it be the 1st through the 5th, or are you going to have them pay in the middle of each month? Does it change? Is there a bonus for paying early? There's all sorts of different things that you can do with this. And the thing that I personally like about it is that it does allow for both people to come to a very good middle ground to figuring out what's going to work best for both people. Because at the end of the day, when both parties can eat is when the opportunity for repeat business really starts to blossom for this stuff. So I like to put that up there because a lot of times when most people consider, and if you have experience in the private lending world or raising money or anything like that, you probably have heard this, but for those of you that haven't, is that, when it comes to getting money from other people, it's not just 30-year, 15-year loans like you hear from banks. It's not just payday loans like you see from places like AmScot. When you sit down with someone and you look at it objectively and you figure out what exactly works, the opportunity for it to be a very fruitful relationship and a very good balance of return on investment and appreciation of not only the asset and the investment, but also the relationship is really kind of the cool part about this. And again, there's a lot of benefits to that. And the reason that we stay on lending is that for the most part, unless you are subscribing to a particular investment or you're putting together something where you are taking on subscribers, most of this stuff when it comes to either using other people's money or being the other people's money, if you will, is going to be loans of some type or another. It's either going to be the one or the other. There's really not a whole lot of other ambiguity of that. It's going to be some type of loan or subscription. We got a couple questions in. I'll just leave this up here and I'll kind of go through that in a minute. How would you pay the legal costs of recourse actions? What I'm assuming you mean there is that in the event of default, who pays the legal fees if you try to come after someone for non-payment? That would be the lender's responsibility. Now, obviously, a lot of times that loans, when they're written commercially, i.e., for your own personal mortgage, that they defer those legal costs to you. Obviously, if you're trying to defer that, they can always, if they don't have money to pay, then, you're not going to probably get legal fees from them. But essentially, if you are the lender on something, it's your responsibility for coming after them and paying any type of legal stuff that would be associated with that. Sue Ellen asked, not exactly sure what that acronym stands for. I find it useful to penalize with bump up in interest rates if in default. Okay. So essentially what she's asking is that if in default or there is non-payment on a note, you can bump up the interest rate. You bring up a good point there as well. Another thing that everyone needs to check with, especially if you're going to be lending, not so much on well, you do if you're borrowing, but your particular state's usury laws. Now, what usury is a set of laws that is determined by each state. There isn't any particular federal mandate on this. That there's a certain amount of interest that can be charged or received for lending someone money. In states like Georgia, they are extremely lax usury laws. States like California, Oregon, Illinois, Florida have very defined usury laws. So typically it's going to be where the loan ends up. So if your person is residing in, let's say California, but you're in Texas, the laws of California will be the ones that apply to how much interest you can charge on that. Check with each state. It is very important because that can really put you up a creek if you have to go to try to collect and sue them for non-payment on that. I think we covered that for Sue Ellen. Let's see. Steve asked, if it's not paid by the SDIRA, would it be considered a prohibited transaction, where's it? Well, it depends. So if it's paid by you, so if legal fees are paid by yourself personally for recourse on a defaulted loan, I would say that that definitely could get you into to issues of it being prohibited. However, if a non-disqualified third party decides to, let's say, enter into an agreement with you saying, hey, I'll float the legal fees if I get a certain amount of, you know, a certain amount of income from the property, or you agree to sell me the property or work it out with kind of like an option or something, you could definitely work it out like that. It just depends on who pays it. Again, disqualified individuals, mother, father, son, daughter, yourself personally. So, it really could be anyone that pays it, but keep in mind that ultimately at the end of the day, the IRA, if they are the lender, are the ones that are responsible for paying those types of fees. Wayne asked, any advice on where to go for legal guidance on lending for owner-occupied homes? Absolutely. Find if you're Wayne, if you're local to the Tampa Bay area, give me a call at 727-754-9954. Or if you saw the first slide, my email's right there. I can certainly put you in touch with licensed mortgage originators that can help you out with that. It's just one of those things that I would always recommend that you go to a licensed mortgage loan originator. They are licensed with state, so you can pull that right off your state's mortgage broker website. And I would look for someone that is a small family office and go and talk to them. They're the ones that are going to probably deal with your investor side of things and are going to be good people to deal with because they're going to be the ones that have the expertise on making sure that these loans are originated properly. And that's really kind of the key term, Wayne, is that when you talk about lending to someone in an owner-occupied home, the term is proper origination, meaning that you have gone through all the steps of income verification, the ability to repay, all that kind of stuff that goes into it under the rules of TRID and Dodd-Frank need to be applied for that. So I can certainly help you out with that local to the Tampa Bay and Atlanta areas. Other than that, a good Google search in your local area can probably yield pretty good results. And also, if you find someone, you can shoot them over to me, and I can tell you whether or not that would probably be a good person to start with. Just because some of these big national banks have what look like local mortgage originators that are really just tied back to Wells Fargo, Fannie, Freddie. So I can certainly help try to get you in a place that might be able to answer your questions. We can't promote or endorse their services, but we can kind of get you a good idea of who you need to talk to for that. Mark asks where to find borrowers. It depends on the kind of deal you're looking to do. If you're looking to do something that is raise regular capital for let's say a rental property in your IRA and you need to get a non-recourse loan, people like North American Savings Bank out of Kansas City or First Western Federal out of Sioux Falls, South Dakota are good places to start. If you're looking for something a little bit more boutique, I always recommend going to your local RIA meetings. There's typically at least one or two a week in your local area. There's a bunch of different podcasts and networking groups all across this great nation that can help you out with that. And most of those people are always looking to lend money out. So that's always a good place to start, is kind of the boots on the ground approach. If it's anything other than just a high loan to value income producing property in an IRA. And Sue Ellen, thank you very much for the clarification. I'd never seen that one, that acronym before, so glad to have expanded my horizon on that one. Okay, so back to it. And again, great questions. Thank you very much, everyone, for asking them. Definitely helps to enrich the presentation, in my opinion. And then some benefits. So unique lending situations are always going to be tougher to get financing for. You're not typically going to be able to walk into a bank, Bank of America lobby and say, hi, Mr. Banker, I have a 3-property portfolio that I'm trying to get 5-year financing on for, the acquisition of a commercial condo complex that has 10 different investors. I just go down the rabbit hole of how complex you can make something. For the most part, commercial banks won't touch it. But, if you have experienced investors and you want to try to get stuff that is suitable to everyone involved, then utilizing other people's money is going to certainly be very beneficial to that. And it definitely increases the chance of repeat business with these people, which can make people a lot of money. If you find someone that is a good fit to work with and you trust each other, a good basis for that can really be the start of a good relationship. And for the most part, from my experience and what I've seen people do, that is where my clients have had the most success is when they can form those relationships, and typically is where they find the most success in that. So Sue Ellen asks, how do the opportunity zones change where you invest and the outcome? That's interesting because the opportunity zones actually, the term for how long these things go out, you invest for, I think it's 10 years in an OZ, and then you can pull out, all of the profits of that, everything becomes non-taxable. It makes it an interesting scenario. None of these opportunity zones have come to that full fruition yet. So from what I understand, and my clients and my associates that I know, we just don't know yet how that's really going to affect everything, because they haven't been around long enough. With that said, I think there's a very interesting opportunity, especially for IRA owners, to come in and then be able to mitigate potential UDFI liabilities by having debt finance properties in these opportunity zones, because it applies to all taxes, which would apply to trust taxes, which they do enumerate on, and UBIT and UDFIT are trust rate taxes. So I would think, especially for the IRA owners that are looking to go out and finance property purchases, doing them in an opportunity zone might be a very beneficial way to do it if they're looking to use financing. So again, we haven't seen the stuff come to fruition yet, so we don't really know how it works until people start claiming OZ tax exemptions and trying to do stuff with that, and how it's going to be affected in like 1031 stuff and things like that. Going to be very interesting. I hope to be doing a webinar in about 9 years to the effect of how the OZs have come into play in the IRA realm. But great question. That's something we'll be looking forward to finding out more about in the years to come. All right. So again, with the great questions, we've kind of run up on the end of this. We have about 10 minutes left. I'm going to go through some of these case studies pretty quickly. I might skip one because I want to get into calculating UDFI liabilities, because again, if we're going to be focusing on other people's money when it comes to borrowing in an IRA, you need to understand that there are some tax qualifications, or sorry, some tax considerations for that. It's not just, you go out, borrow money, and then have, you can take a tax qualified account and just, pump it up with other people's money to your heart's content. You can, but there is kind of a pay to play scenario with that, and also a great benefit to being able to identify what accounts do and do not have to pay acquisition debt taxes. So equity participation. So in this case, Andrea belongs to her local real estate club. She has 100 grand in mutual funds, and she thinks she's going to realize better returns by working with real estate investors. So Steve has a loan, $100,000 to fix up the property. So she decides to lend Steve the money in her IRA. So Steve needs other people's money. She has the money in her IRA. The loan's 100 grand for an interest rate of 5%. The equity participation is 1/3 of the profits. Anything over 100 grand is what is going to be based on the equity participation. 2-year balloon, meaning that she, at the end of 2 years, it pays, comes due and payable. And the first monthly payment is going to be $420. She got the first mortgage on the property. So Steve, through this course of action, goes, buys the property, fixes it up, sells it for 130 grand net after closing costs. So in this case, $30,000 is what she's going to get her profit sharing based on. So in this case, she's going to get $2,500 in monthly payments, $10,000 of profit sharing, for a total of $12,500 of profit on that $10,000 that she lent out over 2 years. So it's a good deal for her. And then also Steve gets a great benefit of borrowing 100 grand, sells it for 130, and then the repayment of loan and everything else like that for it is $12,500. So he comes out of the deal with $17,500 in profit. So it's a great deal for both people. She pays 0 taxes. That $17,500 is going to be taxable for Steve. $12,500 completely non-taxable for Andrea. Option contracts. I really like option contracts. They're kind of a really interesting way to take on debt or give or take on other people's money or give out money to other people, that really kind of has an interesting niche in the fact that there really isn't any repayment. It is money that is given to you for the right to purchase a property or purchase an asset at a certain time, during a certain time, for a certain given amount of money. So Paul needs an additional $5,000 to have his new rental ready for tenants. He decides that instead of finding money from someone willing to lend him the money, he'll find someone that wants to buy the property for a certain price instead. He meets with his friend Joe, and they come up with this deal. So the option amount is going to be $5,000. Joe's IRA receives an option to buy that house for a certain price. So the ARV after repair value of the house is 120. The option contract allows Joe's IRA to buy the house in 5 years for $120,000. So he paid $5,000 for the right over the next 5 years to buy it for $120,000. So then in this case, Paul doesn't have to worry about repaying that $5,000. He gets that $5,000 no matter what. But if Steve comes knocking, if Joe comes knocking and wants to buy the house in the next 5 years for 120, he has to sell it to him. Let's say the house doubled in value. Well, that's what Joe's hoping it does, but that's what Paul's probably hoping it doesn't. So then he has the IRA has the opportunity to buy it. So in this case, the basic procedure is that you open the account, we get the funding in, we review the documents related to the option, and then we wire the $5,000 out to Paul's bank account, and then the option's held in the name of the IRA. 5 years later, Paul wants to sell the house. He calls Joe to let him know he's ready to sell. So Joe's IRA can purchase the property if he has the funds, or he could sell it. He can sell this option to someone for an assignment fee. So that's kind of the cool part about it, is that if you paid $5,000 for something, and let's say there's a $20,000 spread on the property value and what he can buy it for, he could still sell it for $10,000, make his $5,000 back with a $5,000 spread on the profit, and then still be able to do it. In this example right here, he wants to sell the house for $140K. Joe's IRA sells the option to a third party for 20, so they're getting to buy the property for fair market value, and then there's no capital gains, no interest paid back to Joe's IRA, and then he makes $15,000 on this option investment that he had. So a lot of different cool ways you can structure options. He could also have the potential to, if he didn't have it and couldn't find anyone to sell it, then he would have essentially lost it, or he could sell it to someone for a discount, or at the face value of it. So again, there's a bunch of different ways to do this, and then any of those returns that are coming back to the IRA are not going to be taxable. Since we're getting right up on it, I'm going to skip through these. So non-recourse loans is what I really kind of want to make sure that people understand, because when it comes to taking in other people's money, you need to understand that that is where you're going to have potential taxable liabilities with regards to your IRA. So if you are going to be taking in money for your IRA needs to borrow money to buy a piece of property or to get involved in some deal. The IRA is going to have to take on what's called non-recourse debt. All IRA loans, meaning that anything that you borrow in the IRA is the borrower, has to be non-recourse, meaning that in the event of default, you personally as the IRA holder are not giving any personal guarantee. You're not levying any other assets you own outside the IRA as collateral. The only collateral and the only recourse in the event of default is the secured collateral to that loan. Now, that's fine. However, you're going to have to pay some taxes on that. Now, an easy way to look at this is that it's taxed along trust rates. So the amount of average basis in the property over 12 months, so you take the beginning balance and then the ending balance. If you had $100,000 and you paid off $10,000 of it, you take the average between the two. So that's your underlying basis plus the amount of profit that is derived from that and the loan to value ratio. And then it gives you the amount of money, the amount of that income that is going to be based on that tax. So here's kind of an easy way to look at it, is that you have total monthly rents of $12,000, $1,000 a month. The total rent subjected to UDFI in a 50-50 leverage scenario is $6,000. The top tax rate in this can be up to 39%, but trust tax rates are in the bottom for anything under 12.5. So this is going to assume that this is actually over that. So anything under $12,500 in this scenario is taxed at like 11%. So, if you're doing something like this, your taxable rate is going to be very low. The total taxes paid in this scenario would be $2,340. So the net income after that is going to be, the the total income minus the taxes is going to be $5,000 and change. However, the one way to look at this that's going to be very beneficial to those of you that are looking to do this is that if you qualify for a solo 401k, or if you have a small family business and you can, it's owner operated, and you can utilize a 401k. 401ks are exempt from UDFI for acquisition debt. So if you want to go out and debt finance the purchase of rental properties in a 401k, zero taxes associated with that. So I like to tell people, if you're looking to take on money for a deal and do it as non-recourse, if you can structure that somehow to be in a 401k, it is insanely powerful because you're exempted from this tax. So highly recommended. If you have any questions on how to calculate this stuff, I'm more than happy to do it. Francis, yes, this recording will be up, and we are hitting right on an hour for this. So I want to make sure we respect everyone's time. If you have any questions, please feel free to give me a call. I am always happy to help, and the consultations are always free. So please feel free to give me a shout. My number is 727-754-9954. And Trevor, yes, absolutely. The slides will be up on our YouTube channel. So if you just wait for about a day, the other case studies will be right up there for you. So just want to make sure that you understand that. And if you would like a copy of them, just shoot me an email at aperny@advantaira.com. That slide was the very first one. If you have my email, and I'm happy to email you a PDF copy as well if you'd like to have them for your records. So again, thank you very much for attending. The questions were fantastic. I am happy that we weren't able to get to all the case studies because we had such great interaction from people. It certainly helps to enrich the presentations, in my opinion. Hope everyone has a wonderful rest of their day, and thank you for attending.